Comparative analysis of S-corporations versus LLCs, foundational structure and liability protection. The S-corporation and the Limited Liability Company, LLC, are two of the most popular business structures used to shield owners from personal financial responsibility. Both entities provide a corporate veil, meaning that owners are generally not personally liable for business debts or legal judgments against the company. However, their foundational nature differs significantly. An LLC is a business entity created under state law that offers immense structural flexibility, while an S-corporation is actually a tax designation applied to a corporation, or LLC, that meets specific IRS requirements. For the purpose of this comparison, the S-corporation is treated as a standard corporation that has elected this special tax status to avoid double taxation. While both protect personal assets, the LLC is often favored for its simplicity in formation, whereas the S-corporation is frequently chosen by businesses intending to formalize operations strictly. Taxation and self-employment implications. The most distinct financial difference between the two entities lies in how owner compensation and taxes are handled. In a standard LLC, the entity is treated as a pass-through vehicle where all profits legally flow to the owners and are subject to self-employment tax. This can result in a higher tax bill for high-earning LLC members because they pay Social Security and Medicare taxes on the entire net income of the business. Conversely, an S-corporation allows owners to split their income into a reasonable salary and distributions, with only the salary portion being subject to employment taxes. This structure can lead to significant tax savings for profitable businesses, as the remaining profit distributions are free from the 15.3% self-employment tax. Ownership restrictions and eligibility. When considering outside investment or diverse ownership, the LLC offers far fewer barriers than the S-corporation. An S-corporation is subject to rigid IRS regulations, which cap the number of shareholders at 100 and strictly prohibit non-U.S. citizens or residents from owning shares. Furthermore, other business entities such as corporations, partnerships, and certain trusts are forbidden from owning S-corporation stock. In stark contrast, an LLC imposes virtually no restrictions on the number or type of owners, allowing individuals, foreign investors, and other corporations to hold membership interests. This makes the LLC a superior choice for businesses that anticipate complex ownership structures or foreign investment. Management hierarchy and operational control. The management structure of an S-corporation is legally formalized and rigid, requiring a distinct separation between policymakers and daily operators. S-corporations must have a board of directors to oversee corporate affairs and officers to manage day-to-day business, regardless of how small the company is. This three-tiered structure, shareholders, directors, and officers, can be cumbersome for small businesses where one person often fills all roles. Alternatively, an LLC offers maximum flexibility, allowing the business to be member-managed by its owners or manager-managed by appointed third parties. This allows LLC owners to structure their internal hierarchy in whatever way is most efficient for their specific operations without statutory mandates. Allocation of profits and losses. A critical disadvantage of the S-corporation is the requirement that all profits and losses must be allocated strictly according to the percentage of ownership. If a shareholder owns 50% of the stock, they must receive exactly 50% of the profit distributions, leaving no room for creative financial arrangements. The LLC, however, allows for special allocations of profits and losses, provided they adhere to substantial economic effect rules. This means an LLC member could own only 10% of the company but receive 50% of the profits if they are doing the majority of the work or contributed the initial capital. This flexibility makes the LLC ideal for partnerships where contributions of money and labor are unequal. Administrative formalities and compliance. Maintaining an S-corporation involves a higher administrative burden due to the strict corporate formalities required to maintain its legal status. Owners must adopt bylaws, hold annual shareholder and director meetings, and keep detailed minutes of these meetings to preserve the corporate veil. Failure to adhere to these formalities can potentially lead to a court piercing the veil, thereby exposing shareholders to personal liability. On the other hand, LLCs are designed to be administratively light, typically governed by a private operating agreement rather than statutory bylaws. While LLCs must still file annual reports and pay state fees, they are generally free from the requirement of holding formal annual meetings or keeping extensive corporate minutes. Transferability of interests and capital generation. S-corporations have a distinct advantage when it comes to the transfer of ownership, as stock can be sold or transferred relatively easily compared to LLC membership interests. The existence of formal shares makes the S-corporation more attractive to investors who prefer a standardized and regulated equity structure. However, the S-corporation is limited to issuing only one class of stock, voting and non-voting, which hampers its ability to offer preferred returns to specific investors. Conversely, transferring ownership in an LLC can be complex, often requiring the approval of other members and the amendment of the operating agreement. Despite this, the LLC's ability to create multiple classes of membership interests allows for more creative capital-raising strategies than the strict single-class stock rule of the S-corporation. To learn more about our law firm's incorporation and corporate law legal practice, we welcome you to visit our website or contact our law firm to schedule a confidential consultation. Thank you.